Welcome back to our introductory video series on binary options. In this video, we will talk about the risks involved in trading binary options and how to build a smart trading strategy using effective risk management. Many traders consider options trading to be a high-risk and high-reward strategy because in each trade, it's possible to make profits that are multiples of the original investment. It's also possible to lose the entire investment. For that reason, risk management is critical to a successful options trading strategy. There are several key elements to a risk management strategy: allocating your capital appropriately to the strategy, diversification and trade size, and choosing appropriate trades. First and foremost, when allocating capital to a binary options trading strategy, you want to make sure you can afford to lose some of your capital. Many experienced traders will tell you that the first rule of trading is don't lose money. While that seems like great advice, in practice it's impossible to make money without taking risk, and it's impossible to take risk without losing money sometimes. Binary options are a probability game, and even if your trading strategy is advantaged, you will probably still lose money on some trades. Let's say you were to allocate $50,000 to a trading strategy, but you could really only afford to lose $5,000. A few large unexpected losses early on could wipe out your $5,000 and take you out of the trading game. For that reason, do not put money that you can't afford to lose towards this strategy, because you don't want losses in your first few trades to take you out of the game. A better strategy is to allocate only the $5,000 that you can afford to lose. Having a capital cushion where you can afford to lose some of your capital means the portfolio can withstand a few small losses early in the game. Over time, as you grow your trading book with gains from previous trades, you can take larger and larger positions. Once you've determined how much capital you want to allocate to your trading strategy, you need to think seriously about diversification. And along with diversification comes trade size. Remember the proverb, don't put all your eggs in one basket. That is, you need to spread out your risk through diversification. This means you will do several or many smaller trades rather than one or just a few large trades. There's no magic answer as to the right number of trades. It's about finding the sweet spot. If you have 100 positions at once, you'll have a lot of diversity, but you may struggle to manage trading them each day. Something like 20 trades is a good number to start with. Assuming you trade 10 hours per day, this means you'll do approximately 2 trades per hour, which feels manageable. A loss will only impact about 5% of your portfolio, assuming that your trade sizes are similar. Of course, if your strategy requires many hours of research for each trade, 20 trades per day may be too many. Again, there's no magic number that works for everyone. As far as which trades you select, you should also try to diversify your trades as much as possible within the confines of your trading strategy. For example, if your strategy focuses on binary options on currency pairs, you may want to trade a variety of pairs. Trading different pairs means that if there's news on one country that adversely impacts your trade, it will only impact one of your positions, not all of them. If your strategy only focuses on one pair, it's harder to diversify, but you can still choose options with different strike prices and expirations to spread out your risk. Try to stagger your expirations by entering positions at different times during the day and select options that expire at different times during the day. This way, if there's global news impacting all of your pairs at a specific time, you won't have too many positions expiring at once. Finally, you need to choose appropriate trades that minimize risk and maximize profit. This is a balance that each trader needs to find for his or her strategy. In order to make profits, you need to take risk, but it's about finding trades that have appropriate levels of profit potential to compensate you for the risk that you're taking. Risk management is one of the most important elements of a successful trading strategy. If you get this part right, you'll avoid unnecessary losses and trade smarter.